Once again, guys, this is Prince Dice here from the Royal Financial Investment Group, coming to you guys live from Hawaii with another great, awesome video. I know it's been a while since I put up a financial video. I've been around the world a little bit. You guys see me in Singapore to the Philippines. I was in Japan for a little while. I was in South Korea for a little while. But guess what? Now I'm back at home here in Hawaii. But I don't have a lot of time, and I definitely know you guys don't have a lot of time. So guess what? We're going to jump straight into it. So as you guys can already see, the name of this video is probably going to be Nike stock versus Under Armour stock, or vice versa, Under Armour versus Nike, or whatever. But I'm pulling up this video to kind of just give you guys raw, full numbers of what I look at and things that I see as far as Nike. Now, for example, Nike just released their earnings report this past just a couple. I would say right with the market closed. The market hasn't opened up yet, but their earnings I thought was pretty decent. But it missed Wall Street's. Well, it actually beat, as you can see up here. It beat the estimates that the analysts had, but something in there. I haven't read their whole financial report. I'm pretty sure it hasn't updated all the way to E-Trade yet, but somewhere in there, stock started trading down. I think it's trading down now 6%, pretty much going for $61. But that's besides the point. So we're going to look at this. We have Nike pulled up here with stock symbol is NKE. So we're going to stroll over here to the fundamentals, right? Because a lot of times when we look at stocks, don't get me wrong, I'm biased. I love Under Armour. I think, a couple years ago, a lot of the videos you see me wearing, I wear the Under Armour hoodie, Under Armour t-shirt. I like the way the company's going. It's giving Nike a little run for its money, as it seems, and stuff like that. It's a new kid on the block. Has great growth potential and stuff like that, so I do like it, but I'm not a big fan of the Under Armour stock right now. I think it's a little pricey, and we're gonna just go run through it now. Actually, we're gonna pull up Under Armour first, then we're gonna go to Nike. So as we all know, Under Armour right now is trading for $84.45. So we're going to take a look at some of the fundamentals on Under Armour. Let's go here. We have the debt to equity ratio. The debt to equity ratio. This tells you, this gives you a good example of how aggressive a company is with spending its using credit to fund its growth. For example, you're a brand new company, you need to create these new shoes, you need to create these new commercials, marketing, advertising, endorsements. You have to pay all this type of money. You don't have as many sales yet, but you have millions of dollars you have to put into this idea first. So the debt to equity ratio tells you how much money is being borrowed in order to fund the growth of this company. Because a lot of times we become not confused, but we become caught up on how much a company is making. Wow, this company made $5 million, but we don't know how much debt that company took on board just to make that $5 million. And being in a economy with a rising interest rate, sometimes depending on how they got their debt, the price of borrowing money could go up, so which could hurt a company's bottom line in the long run. So it's something that I like to pay attention to. Debt to equity ratio. A lot of people saying, "Oh wow, it's making all this money, it's doing all the other good stuff." Then people don't look at how much debt they accrued, how much debt they took on board to fund that growth. So right now, looking at this, the debt to equity ratio is not extremely high, but it is higher, way higher than Nike. But it's one of those things of being a young, small company. Not a small company, but being a young, up and coming company. Now, another thing I look at, price to earnings ratio. Right now, this is kind of give you the PE ratio, saying, hey, look at the price of the stock compared to its earnings. Right now, Under Armour is trading for $84, right? And compared to its earnings, it is considered to be significantly overpriced compared to its industry right now, going off of its earnings or whatnot, right? How you can tell that is right up here, it tells you the industry. This is the apparel industry, right? Apparel. I'm sorry. But when you look at this is going to compare, in your industry, it's going to compare the PE ratio to other PE ratios in that particular industry, right? And the good thing, I don't want to look at this one here, just look at PEs, right? So here it's saying that the PE ratio is 25 in this industry. As we saw on the previous page, Under Armour is sitting at a whopping what was it, 81, 84. So that can give you the impression that this company is trading pretty high right now. That's one of the big reasons why I'm not a big fan of it, because I think it's a little pricey right now, and with my belief that the economy and the market is probably going to go for a little bit of a slide. Companies that are overpriced are going to get hit the biggest or the most or whatever. And also another thing, Under Armour does not pay dividends at this point. It hasn't announced a dividend. It's a little priced at this point compared to what it's earning. Now, I'm not really concerned with the financial strength of the company. This is something you can look at with the quick ratios and stuff like that. But I'm not going to look into that. We're going to go over to the earnings tab. Let's see how much this company is bringing in, right? Revenue. Right now, it's projecting this year to bring in 5 million and 5 billion, correction, 5 billion in revenue. It's projecting to go up to 6 billion in 2017, and in 2018, it's projecting to go to 7.9 billion, which is cool, which is fine, right? So last year, Sandy had a revenue of 4.0 billion, and the revenue is telling you how much a company generated from all its sales and stuff like that. Now, like I said. Now, just because you made this in revenue doesn't mean it's straight profit. You brought in 4 billion, but how much money did you spend in marketing? How much money you spent in raw materials? Whatever it took you to make that money. So revenue is just giving you a good picture how much money is this particular company bringing in, right? So, not bad on that. Earnings summary. Let's take a look at that for a quick second, right? So this year, I'm thinking that they're talking about this in the millions here, if I'm not mistaken. So last year you had 1.5 million. This year you got 1.31 million. What they're projecting, and 1.68, all with the 2 million. Not bad, right? Not bad. But when we look at Nike, who's trading for significantly less, which is trading down because after the earnings report, a lot of people selling off the stock, which is going for about $61 right now. Looking at the aftermarket, when we take a look at their earnings. We're going to take a look at their earnings, their PE ratio, and stuff like that. So first, let's look at their earnings summary. So they're at Nike here is at 1.85, 2.5, 2.15. It's just the number is just a little bit higher than Under Armour, what they're projecting now, what they're projecting in the future, but they're trading for lower. They're trading for $60 right now. And also they're paying a dividend of 0.99%, a dividend yield that you're getting right now, 1% pretty much. So it has a little dividend that's there, and it's trading lower than Under Armour is trading. Now its PE ratio is still sitting up at 31, which is a little bit higher, which is higher than the industry right now, but we're just comparing Under Armour and Nike. So when we look at these two, let's go over here to revenue. Right, we looked at the revenue for Under Armour. Let's take a look at the revenue for Nike itself. So we here, remember, Under Armour was at 1 and 2 and stuff like that. Last year, it made 30 billion, 32 billion in 2016, 36 billion. So this is a lot more revenue. So when you see this much more revenue, you're seeing this much more earnings. Why is Under Armour trading so much higher than Nike? One of the big things is just, if you saw my video on Tesla versus Ford, is that Nike has been around since the 60s. If I'm not mistaken, Under Armour has been around since 96, the mid 90s or whatever, 20-year company versus a 40, 50-year company. So, of course, Nike is more imprinted. They're pretty much they paved the way for all the other apparel companies that came behind it. So it's a little bit more solid. So, it's a little bit more mature than Under Armour. Under Armour right now, it has Stephen Curry, which is the league MVP, Tom Brady, which is a big name in the NFL. Cam Newton, if I'm not mistaken, which was last year's league MVP. So it has a lot of big names. I don't know all the other endorsements that are out there, but I'm pretty sure it's more. So it has a lot of upward mobility. So that makes a lot of people excited. Like me, I'm excited. I love Under Armour. I was buying it when I saw it on the market. Hey, I got to buy some of that stock. But when I did my research and I looked into it, as I look into these numbers, I'm not going into detail. I want to make the video too extremely long. But when I looked into numbers like this, going into the key ratios and statistics and pulling out the numbers on it, I think it's a little bit overpriced right now. And when do people buy stocks? You always create bubbles. People buy stocks when we see things going up. For example, you take the company of Tesla, who has reported losses for the last 11 earnings report, just loss. But the company continues to trade higher, because people, become excited off of commercials. We can become excited off of what is to come, not what's actually happened. We don't look at the actual numbers of the companies, and we don't pull back the layers of the onion and see how much this company is earning, why is it trading this high, what am I getting in dividends, what's the overall gist of the market, what do I plan on the market being, all that stuff like that. We just look at, hey, we look at the commercials, we look at the merchandise, we look at, hey, what's to come, and that's what a lot of people trade off of instead of real numbers. This is why we have bubbles all the time in the market. We had the dot-com bubble, you had the housing bubble, because we lose reality of the real value, and we start looking at the future, and we start looking at the price. That's why I like to look at the numbers. So here, I don't want to, how you can get to this yourself. If you want to do a little research yourself, you go to fundamentals, right? And you see right here, the investment portfolio report. And this is one for Nike. And I also have the one for Under Armour that's up as well. Pretty solid and easy to read. For the most part, you have your PE ratio, have your how many employees, market capitalization. For example, market cap over here is 100 million for Nike, and over here we have for Under Armour is 17 million. And market cap is a good way for people to look at a company and tell how big it is. And usually how big a company is, they look at that and say, this is a safer investment. This makes a blue chip stock or whatever. So right now, Under Armour doesn't have a major, compared to Nike. It doesn't, Nike, of course, has been around longer and stuff like that. So it has a bigger market capitalization. So you have everything from market capitalization, how many employees, the share prices. Another key indicator is current ratio. Financial strength, I'm not too concerned over the financial strength of Under Armour and Nike at this point. Profitability, yes, that's a good one to look at. Gross margin, we're just taking the gross profits and revenues. Of course, right now Nike is winning in all of those departments at this moment. As on paper, Nike looks like to be the that big solid company that I would probably go with at this point if I wasn't being as risky. If you want to be risky, I would say right now, how things look, Under Armour seems to be a little bit more of a risky investment, but it has great potential to grow. But also you got to think of the climate where we're in, election season, what the market is at, and when markets will slide. Because when the whole market slides, everybody slides. In 2008, everybody was going down unless you were something like gold or the utility industry. But I don't want to make this video too long. I don't know how long I've been on this video, but I can talk about this topic forever. But I hope I'll open up your brains to something, a new way of looking at something, and just sharing my thoughts and opinion. But as always, don't forget to like, subscribe, and comment, and share. And don't forget to, share some of your thoughts. Give me some of your opinions. What you guys think? Nike or Under Armour? But anyway, until the next video, I'm back now. But until the next video, you guys already know what to do. I'm Prince Dykes. You guys be safe. Peace.